Hi Scott, welcome on UBP's podcast.
Hi Rachel.
Europe is not going so well right now and investors tend to shy away from European equities. How would you react to that?
Well, we do clearly face some headwinds to growth and to stability in Europe at present. There is a general lack of confidence which is hampering investment spending, and also some concerning political developments, notably in Greece, Spain and the UK. We're facing general elections in the coming year in all three of those countries, and radical new parties like Podemos in Spain are proving popular to the electorate. So it is natural that many investors will shy away at this time. But it's also important to remember that we invest in companies rather than economies, and the European corporate sector is in excellent shape. There is great value in Europe, and companies have reduced debt significantly. They also have extremely low borrowing costs.
Okay. And in your outlook, you stress the importance of income. Could you explain why?
Dividend income, we think, is going to be very important going forward. European equities have a very attractive dividend yield of approaching 4% for 2015. This is above long-term averages and really stands out relative to other asset classes. We actually think dividends can grow from here as payout ratios are not stretched. Elsewhere, we have close to zero risk-free returns for the foreseeable future, so 4% is a great starting point before any capital appreciation.
So given the current financial context, what adjustments exactly would you advise within a European equity strategy?
Well, our approach would be to maintain a pretty well-balanced portfolio at the moment. Despite the risks we discussed, there's also the possibility of full QE from the ECB in the new year, and cyclical stocks could move pretty sharply on this. So we wouldn't be too defensive, and we would advise a bias towards dividend yield wherever possible in terms of stock selection.
And last but not least, how does the US momentum affect investment in European equities?
Well, the growth momentum in the US is really encouraging, and many European companies do have exposure to this. We've been particularly drawn by the later cycle US exposure offered by stocks like building materials group Wolsey and lockmaker Assa Abloy. A broader consequence of the strong US growth and ECB stimulus has been the relative weakness of the euro, and we think this will prove to be a strong support for European company earnings going forward, particularly in sectors such as the healthcare sector, where US earnings are very high as a proportion of the whole.
Thank you so much, Scott, for your time.
Thank you very much, Rachel. Good to talk to you.